You degens, you dirt bags, and best friends who I've never met before. It's your boy Max Pitts from Trades and Gains. It's your weekly close of market intel. Everything you need to know heading into the first week of June 2025. The S&P just had its best May since Top Gun hit theaters, up 6% in 1 month. But this week, we're stepping into the fire. Jobs data, earnings, and Trump's tariff war 2.0. This week could flip the script for bulls or bears. Let's break it all down and make sure to hit that like button, subscribe, while we go ahead and jump straight into this. So when we're looking at our May last month, it was a monster month. The S&P 500 was up 6%. That's the best May we've had in over 35 years, by the way. The Nasdaq was up 10%. Tech went absolutely turbo with the gains, baby. And Dow was up 4%. They're still riding the wave. Let's remember, the Dow Jones Industrial is the red-headed stepchild of our indexes. Now, what is the big reason here? Trump's tariff rollback early in May sent stocks soaring, but the relief rally is running into resistance. Just this Friday, Trump dropped a bomb on Truth Social, basically accusing China of totally violating the trade deal. Boom! Stocks absolutely slipped. Wall Street's biggest fear here? Policy whiplash. We get bullish headlines one day and bearish bombs the next. Now, this week, buckle up because we got a hell of a calendar set up for you guys. Let's go ahead and scroll down to our calendar for the week, ladies and gentlemen. Now, Friday, we have the May jobs report. It's the big one. Here's what the street expects. We're expecting non-farm payrolls to hit 130K. We're expecting unemployment to hold at 4.2%. And the average hourly earnings is supposed to be up 0.3% month over month. But here's the twist. Wells Fargo says the soft labor market could start showing up now thanks to all the tariff noise. If job growth slows, the Fed might get nervous, and that could mean a rate cut is back on the table. But if it's hot, rate cut bets could get wrecked. Remember, rate cuts, one of the goals of the rate cuts is to protect the labor market. So if we keep getting cooler and cooler labor market data, guess what that means? We'll probably get a rate cut to protect the labor market. However, we need to remember the buyer's remorse that most Fed members felt after delivering those types of cuts. Now, if job growth slows, the Fed might get nervous, and that could mean a rate cut is back on the table. So that is one thing to keep in mind. Now, earnings are cooling down, but a few big names are still on deck here. On Tuesday, we have CRWD, CrowdStrike, AI plus cybersecurity equals a hot combo, especially in this market. Dollar General, we're seeing good read on consumer health. But as we know from the consumer reports that we've been getting over the last couple months, that consumer health report has not been, well, healthy. It's been more diabetic and obese. We have Hewlett Packard Enterprise earnings as well. Thursday, we have Broadcom, a key chip maker. Watch for AI insights. Remember, with Broadcom, they are going to be a staple and a corner of what we are expecting for smart cities moving forward. Now, DocuSign, we also have coming up on Thursday. Is remote work still driving growth? I know personally, working in tech, the hybrid model is becoming more and more prevalent, but in office is becoming more and more prevalent as well. Lululemon, again, consumer luxury pulse check, but with that consumer spending being down, as we've seen with PCE, I would not expect Lululemon to have a very aggressive earnings growth here. All eyes, however, will be on guidance. With all this macro uncertainty, forward-looking statements matter more than the past results. And that's why for earnings, we've been seeing tanking happen. Because guess what? These people don't care about what you did last quarter. They care about what are you going to do next quarter to help kind of absorb some of these tariffs, right? Now, let's talk tech. The Magnificent Seven, Apple, Amazon, Nvidia, Tesla, Meta, Alphabet, and Microsoft are still carrying the market. Q1 earnings showed a 27.7% year over year growth. They beat estimates by 11.7% on average. Meanwhile, the rest of the S&P only managed 9.4% growth. So that's almost 3x growth from the Mag 7 alone. That's why the MAGS ETF is up over 11% month over month. Citi says until bond yields cool off, investors are hiding in these mega cap moats for right now. When in doubt, always go the growth model, folks. Now, let's not ignore the elephant in the room. Tariffs. Early May looked like we were heading toward de-escalation, but now we're back to headlines and heat. One day it's tariffs pause, the next day they're reinstated. And now tech sanctions are back on the table. This is uncertainty, and this is a headwind for China exposed stocks, industrials and materials, and global supply chain players like Tesla and Apple. So what should traders do? Let's go ahead and talk strategy here. So some key SPX levels this week, we're looking at 59.50 for previous May highs. Support, we're looking at 58.60 where buyers stepped in on Friday. And our breakout zone is going to be above 59.50, possible June melt up. And that breakdown zone is going to be below 5,800, which could mean it's time for a correction with SPX. The Nasdaq's already flirting with new highs, and tech is leading the charge. But if jobs data disappoints or tariffs escalate, we could see a quick fade on that as well. Now, this week's game plan, we're going to stay nimble. Earnings are light, but headlines are going to be very heavy, like a woman on her period for the second day. Watch Friday's jobs report like a hawk. This could shift rate cut bets. Tariff risk is absolutely real. Manage exposure to China-sensitive names. Tech is still king, by the way, but it's stretched. Tighten the stops on your winners because those 1,000%ers, yes, those are great, but profit is profit at the end of the day. And June can be volatile. Don't chase, let the market come to you. Play the chart, don't play your bias, because playing your bias is how you will get, well, burned. That's why bias starts with a B, because it burns you. That's your full weekly outlook, though, folks. Let's recap real quick. Jobs report is going to be the market mover for the week. Tariffs is the absolute wild card, so watch out for any unhinged tweets from our POTUS. And tech is still carrying the torch. Drop a comment below. Are you going long into jobs data, or are you going to sit on your cash? And don't forget to vote in our weekly poll. Will Friday's job report push the market higher or lower? We give out these weekly recap videos and weekly outlook videos every Sunday morning. Subscribe, hit the bell, and stay ahead of the curve. Until next time, trade smart, stay sharp, and as always, let the gains begin.